My next group of panelists, I'm really excited about this, is Chris Lee, who's a partner at FAA, Pierre Mendelsohn, who's at ALPIMA, and Larry Hatheway, who's with the Jackson Hole Economics. And this is going to be interesting if we can bring them on. And as I make quick introductions, it's funny when I have Chris on, he always brings academia, research, macro trends that the environment is seeing. Obviously, what we want to hear from Pierre and Larry is what they see on a macro level, what they see happening globally. It's funny, I was reading an article the other day about how people are making and losing money in the stock market. And you find that a lot of people are focusing on buying product, and they spend a lot of time and effort learning about that. And they don't spend enough time on when to sell these things or when to get out. And therefore, if you look at the averages going in, going out at the wrong time, you're not making as much money as you thought you were. So just conceptually, when you start having academics and smart brains in the room, like the three of you, it's going to be fascinating. So Chris, thank you for joining us. Thank you for bringing your wonderful panel here. I'll let you start off with an introduction of yourself, the others, and your topic. I'm sorry we're running a little bit late, but we'll give you a little bit of time on the other side.
No problem. Yeah, thank you so much, Kareem. So this is Chris Lee. I am also an investor and a strategic advisor to Link2. So it is my great honor to have two of my panel members here. Let me make a quick introduction of my two guests. So first, let me start with the topic of today, which is macro investment technology, right? So this is a subject that I think Pierre and also Larry will speak a lot and also provide a lot of content to it. So zooming in from London, we have Pierre Mendelsohn. And so Pierre is the founder of ALPIMA. So 6 years ago, he founded ALPIMA, which is basically a SaaS-based investment platform provider, right? Focusing on object-oriented investing. Now, that is a bit of a mouthful to me, but to put it in layman terms, he is making smart investing simple. Smart investing made simple is the tagline for ALPIMA, similar to Link2, which is making private investing simple, right? And so the company is founded by Pierre and also funded by a big name VC that hopefully he'll share with us, and also the principals. And so, 6 years ago, he founded it. And then before that, he was also an investment banker, holding very senior positions with Morgan Stanley, global responsibility in equity derivatives and also structuring. And prior to that, he was also a managing director at Merrill Lynch out of London office. And did I also mention that before his 20 years career on Wall Street, he was also a rocket scientist. So, earning a master's degree in aerospace engineering from a tiny school named Princeton on the East Coast, right? So welcome, Pierre, to our panel today. And
thank you very much.
Second on our panel is Larry. So Larry, hello. So zooming in from New York City. So Larry is the founder of Harbor Advisor and also Jackson Hole Economics. So, those of you who know the location Jackson Hole in Wyoming, you would notice that this is like the Davos meeting for all the central bankers and also top finance leader that happens once a year in Jackson Hole, Wyoming. So, so this is both the private side as well as the not-for-profit side of Larry's current career. So we'll hear a little bit more from him later on. And before founding this a year ago, Larry was the chief economist for GAM, which is Global Asset Management out of London. And before that, he had a distinguished career with UBS Investment Bank for a total of 23 years, also in economics, and ultimately acting as the chief economist for UBS Investment Bank globally. And so Larry is also from the West Coast originally. Actually, he attended college up in Walla Walla, Washington, I think Whitman College. So again, welcome back to the West Coast. This is a crowd that you are familiar with. So that's a brief introduction, but I'd like to just maybe ask you to just add to that introduction a little bit, give us a little bit of update on what you have been up to. Perhaps we can start with Larry first and then go over to Pierre. Larry.
Okay.
Well, lovely. Thank you very much, Christopher, and thanks everyone for joining this particular segment of today's conference. Taking up Christopher on that, he had mentioned the two ventures that I'm now involved with. Jackson Hole Economics, as he mentioned, is a nonprofit, and our aim here is really to try to provide, in layman's terms, jargon-free, plain English, views not only of our own, that is my partner Alex Friedman and I who are engaged in this, but of a host of other writers. We have a stable now of up to about 40 different contributors on issues of global economics and finance, but also public policy and the environment. And I guess the underlying principle here is that we're trying to create a forum for engaged discussion around key issues that are not short-term, they're generally speaking longer term, about nudging society back towards more sustainable paths, both more sustainable outcomes, but also more sustainable dialogue. The other venture that was mentioned is Harbor Advisors, and that's, as Christopher also said, a business venture of mine. And in that, I'm advising institutional clients and family offices worldwide, primarily in areas of asset allocation, both strategic and tactical.
That's great, Larry. Thank you so much. So, Pierre, perhaps you can give us a bit more background on ALPIMA. You have lots of major clients, Julius Baer and others, and what's new?
Sure. Well, thank you very much for having us. It's a real pleasure to be with you. You mentioned aerospace earlier, and I want to share something with you, which is long before I was in finance, I remember I worked for an aerospace company called Dassault Systems in Europe. And what they did before they launched a plane is they modeled the plane digitally. So you create a model of the thing you want to fly, and then you eventually go and fly it. And then I worked in finance for a long time, and it struck me that the one thing finance doesn't do very often is to model whatever it's going to do before it does it. In the same way that other industries do. There's some sort of modeling, but it's not quite the same depth. It's not quite as advanced. And so really what ALPIMA is a company that helps our clients, asset and wealth managers and banks, model their objects before they go and deploy. And what that means is you can do a number of things with them which are wonderful, because you can visualize, you can backtest, you can stress, you can shape, you can customize, and all these things can happen digitally before you actually deploy capital to the purpose. And so that's really the main aim. It's a SaaS approach. The one thing that's exciting, technologically speaking, is that when you think about it for a second, any portfolio really can be thought of and described as an object, a digital object with a code and a unique identifier. And once you see the world that way, it's extremely hard to go back to previous tech, which is typically spreadsheets and a market feed or something. So it's one of those things which sort of, gets into the brain of, well, it's certainly got into my brain, and it's getting to the brain of our clients in a way that's really heartwarming to see, because it's really changing the way people think about investing, because all of a sudden you can see things before you deploy. You can actually test, you can experiment, you can prototype, and then hopefully you can get to a better result at the at the end when you deploy the product. And hopefully you can also better serve clients, which is the one thing that is interesting. Is this industry is the finance as an industry is trying hard to become more client-centric. And I think most people that we speak with really want to serve their clients better. They find it hard to do, though, if you use the current tech. So you need not only to want to serve your clients better, but you need new technology to do that. And so we're seeing that. And of course, nothing happens in a day. And even if you deploy this kind of tech into an enterprise, it takes time to deploy, to get adoption and so forth. But what's good to see is that people seem to want to move the needle and serve clients better, because once you get tech to get in the workflow, you can do things that were perhaps unimaginable a few years ago. I mean, look at us today on Zoom. It's amazing to be here with you today across the world, where, it's been said before, I think in the previous session, but I think it's incredible. And the one thing that I want to perhaps highlight is the notion of digitizing what you do isn't just cool in itself. It saves the biggest asset that people have really worldwide, we all have, which is time. Right? So if you can save time by digitizing your object, and if you can gain insights, the value you generate is just huge for clients, for the people that actually do the work. So that's what we do. We're super excited about what we do, because it's cool tech and it's got a real purpose. It's trying to solve a real problem. Not all of it is easy, to be candid, right? So the real issue of doing this is you've got to be able to integrate with clients. And I guess that's really, you know, where the rubber meets the road. So the real skill is not just to come up with the idea, it's to be able to connect that into real enterprise. And as you all know, real enterprise have existing systems. Nobody operates in a vacuum. You've got to be able to connect into market data, into existing websites, into existing systems. And that's where we've discovered that actually a huge amount of the value lies. It's not just the platform itself, it's its ability to connect into existing infrastructure, which is where it becomes useful. Otherwise, you're just talking and it's just, you know, R&D as opposed to production.
Oh, I agree with you, Pierre. And, you know, I'm also hoping that we could, you know, take all the inputs and put it in your model and produce useful investment decisions for clients and investors, being client-centric, as you mentioned. So if we stick with the topic, which is the macro piece, right, in your investment technology. So clearly we should, you know, ask Larry about his macro view of the world right now. Currently, I think it's not an overstatement to say that in light of the current COVID-19 situation, right? And as an economist, do you expect like a V shape or W shape or U shape or any type of L shape recovery of the US economy, or maybe a global picture? If you can share with us your macro thoughts on this, we can then go into taking some of the inputs to put into a PS model.
Right, so I'll come back to some of the nomenclature, the letters of the alphabet, as it were, in just a moment. To try to answer the question as succinctly as possible is really to try to understand whether through medicine largely, that is the vaccines, we're able to gain control over the pandemic, which has swept the world economy. We may now tend to forget, since it's been not quite 12 months, but close to a year since the pandemic arrived, what the world looked like before then. And on many metrics, it was quite healthy. High levels of employment across both advanced and emerging economies. And without the presence of inflation, strong performance across most capital markets. There were things perhaps not to like, which I'll come back to in a moment, but certainly it was an agreeable state of affairs, which was rudely interrupted by the arrival of the pandemic and the nature of the policy responses that ultimately I think were required to mitigate the suffering, the human suffering and the death that resulted from that. Social distancing in all its forms obviously had significant impacts on economic activity. And if you look at the last 9 months or so, and then begin to think about what the full year numbers for 2020 will look like, will certainly be the largest contraction in UK recorded history. It will not be for several other countries like the US and perhaps say Japan, but it is in the top 5, let's put it that way. And it's a more severe global contraction that we've seen at any point in time for which we have gathered data. So we can't underestimate the impact that that had on economic activity. But if we take as a given, which is a debatable point, but take as given that the vaccines will both be effective and will be adopted widely by populations around the world, then I think we can begin to think about this as having V-shaped characteristics to it. There's really not much else that's holding back the recovery of a broader economic activity than simply that. And certainly we have a great deal of policy support that would also support that thesis, namely very easy and accommodative monetary policies, strong capital markets, once again, which are facilitating the financing of businesses. We have no sort of liquidity or banking problems to slow us down in that recovery aspect. So much hinges again on the vaccines being both effective, being distributed effectively, that should be part of that, and being accepted, that is, by the population to achieve what we might call herd immunity. Final point that's not often discussed, but we also want to be certain that both taking the vaccine is safe, but also that it confers a long-term immunity from the COVID virus. The COVID virus doesn't in some ways maybe mutate, that puts us back at square one again. So if we make those assumptions, then something V-shaped is right. But it's also probably important to note that the prevailing world that I described in somewhat positive terms before also had distinctly K-shaped aspects to it.
K-shaped, okay.
Yes, that is a K. There's a bit that points upward, and that was enjoyed by a relatively modest number of people in the United States or globally. And that for a big segment of the population, it does vary from one country to the next, despite high levels of employment, there was stagnation or even a decline in real living standards that had been underway for a very long period of time. And 2020 has exacerbated that. Most of those people have fallen further behind, potentially even falling to the point of viability, that is losing their shelter or other aspects of basic sort of living. Whereas the elite, the 1% or whatever you want to draw that line, has prospered, and in particular because of the strength of capital markets. So the V is probable in a broad macroeconomic sense, but ultimately I think over time, once we put COVID behind us, addressing the K and all that that implies will be a very, very big challenge for society.
Thank you for that, Larry. I mean, that's a lot of information and also so many factors that you just mentioned, right? I think we're going to need a CPU to process all that information that you just mentioned. And I know Pierre's business, you know, in a way, I can also describe it as like he's the CPU that goes into the motherboard that powers the PC that will actually help all the institutional investors and also small investors like myself, right? So Pierre, can I now come to you and ask you, how does your chip, right, help big and small investors?
Yeah, so firstly, that relates, thanks, Chris, that relates to the way in which we integrate with our enterprise clients, whether it be to feed data in order to model the portfolios, in order to also reach out to a front end that needs to render the results to clients. Typically, our clients already have an existing interface that they use with their clients. And it could also be about connecting to existing systems, for example, execution. But I wanted to give you an example to echo on what Larry said, which is really interesting. So obviously the world is in a very particular place at the moment, and you can imagine people having strong views on asset allocation. And so, as you know, if you just run a blind model today with no views, for example, you'll get to a certain result. If you take a typical markets approach, and I just want to share something with you, just by way of comparison. If I put in a global basket of US-based indices containing fixed income, equities, and a bit of commodities, and I give no views into the model, I'm going to get a certain outcome. And the outcome today is very much fixed income focused, actually. Just to look at numbers now, a blind model will go into 67% short-term treasuries, 13% long-term treasuries, a bit of equities, about 13% equities in developed, 5% in emerging market, and 3% in gold. So that's a model with no views. It's a model that knows nothing and looks simply at risk. Now, thanks to people like Larry, people have views. Right? And we'll, for example, say that the fixed income segment needs to be looked at with care, given that rates are at very low levels. You may want to also express positive views on certain segments of the economy and so forth. So the question is, how do you take those views into account? And the great news is great minds have thought about this long before we have. People like Bob Lederman came up with a model in the 90s that allows you to basically shape models doing that. So that used to be done in the industry before, and it was quite hard to access that kind of feasibility. What tech makes possible today is to actually let clients say, look, I want to invest in this universe. I've got these views, and I want to see what this does to the shape of my asset allocation. And before you go and deploy, you can actually play a little bit and say, gee, what if I change that view? What if I put in this instead? And that allows people across the chain all of a sudden to have access to this intelligence, which as the case may be, may not be that intelligent sometimes. But at least you're able to see the data, get the sensitivities, get the risk distribution, and get an alignment between your thoughts and how you're going to deploy capital. So on macro, for example, I think the big challenge that we're observing many of our clients face is how do we deal with fixed income? We've got countries in Europe with negative rates. Switzerland has negative rates, right? We're not talking zero, we're talking negative. How do you justify going into this when the wisdom is 60-40, right? So you've got to come in, there's got to be some way of rationalizing this and explaining to clients so that it does make sense in the end, whether it be macro views or whether it be a more micro set of views on particular segments. You can imagine the environment now is actually a really serious topic. Most of our clients describe it as top of the agenda, and it's in multi-year plans, and it's discussed with every client meeting. How do you go to clients that actually take it into account intelligently in a way that you can measure and implement? And this is where tech makes it possible today. And Chris, you know, you and I were talking about this 20 years ago. We were only dreaming that this might be possible. It's a little bit like people talking about iPhones before they existed. I guess today in finance, the same things, right? And now you're basically able through tech to simply do these things and connect the math to clients in a way that would have seemed unimaginable before. And the last thing I'd say, which has been wonderful, is that the world has made this so much easier because of things like the cloud and all this huge computing power that we've got. I mean, to give you a sense, we think that, you know, ALPIMA before in the 90s would have needed 10 times the number of people to run, if not more. And today we can do all this good work with, you know, much more agile, lean teams.
Right. Well, you know, building on what you mentioned earlier, Pierre, about negative rates in Europe, right? It's not just in Europe, in Asia as well. Negative rates in Japan. And
absolutely, yeah, of course.
One macro factor that I'm very afraid of is, will there be a negative US dollar interest rate in the American market, right? And now I'd like to go back to Larry to make some comments about the possibility of a negative US dollar interest rate in the United States.
Yeah, thanks. And Christopher, don't be afraid to ask me later about things that Pierre just mentioned, because touches on some work that I have done too, and I'm really fascinated to explore that a little bit with him as well. If time
Absolutely,
yeah. Negative interest rates in the U.S. Well, Pierre has mentioned that Switzerland has them and has had them along its yield curve, you know, out to a 10-year bond issuance. Germany has as well. Policy rates have been set at negative levels in various countries, primarily in Western Europe. Would the Federal Reserve do the same? So we'll start first with the policy rate. At the moment, it seems unlikely, and I would say actually pretty unlikely or highly unlikely. The Federal Reserve has made a pretty strong case over the course of this year, and to some extent had touched on it in earlier periods as well, as to why negative interest rates were unlikely to produce benefits that would outweigh the costs. And the costs are largely borne by the financial system broadly, that will include banks, but also by other asset gatherers and who have to invest, or at least have to invest largely in fixed income, like, for example, insurance companies and pension funds. But it also punishes savers and pushes them potentially into risks that are untoward, that is, that they shouldn't be assuming themselves given their own circumstances. The Federal Reserve has believed instead that through both asset purchases and what they call forward guidance, that it can reduce real interest rates, and most recently by trying to change people's expectations of long-term inflation by adopting as an objective an overshooting of its inflation target. Remember, I guess in the world of economics, what central bankers are trying to do is to push down the real rate of interest, the real cost of borrowing, to facilitate investment and to some extent also spending. And so they feel that they have tools. I will say, though, before I leave the subject of policy rates, Federal Reserve has also been emphatic as a central bank, as an independent central bank probably can be this past year, that in the current circumstances, fiscal policy really has to play a big role. And they've been big fans of both the first fiscal stimulus package, and in their own way have been trying to prod Washington, the rest of Washington, into adopting a second one, despite the advent of a vaccine. Long-term interest rates, at least in intermediate areas of the curve, potentially could go negative. In other words, market forces could drive them there. And that's what's happened in Europe. In other words, you don't have long-term interest rates negative in Europe simply because short-term rates are negative, but also because of very, very strong demand for those instruments from the financial sector primarily. And there are scenarios, I think rather unlikely, but there are scenarios where the same thing could unfold in the US. But I don't think that policy rates will go negative, to answer your question succinctly. Not in the United States.
Well, good to know. And so I think we can see that both Larry and I are very excited about the technology that Pierre is producing for investors, East Coast, West Coast, and globally. So if I can come back to you, Pierre, on this, I mean, could you give us a more concrete example of how the technology could be applied to like a private bank, perhaps Julius Baer, or maybe a hedge fund or a mutual fund, with a little bit more sort of like, concrete example?
Sure, no, of course. The common thread across all the clients is that they basically want to digitize the process of creating portfolios, visualizing them, and deploying them to clients. That's really the one big problem that people are trying to solve, especially when you've got a legacy business that there's some scale to it. And so the way this happens in practice, our platform is used to basically help people build portfolios quickly, test them, and then deploy them. And once you've got this, you can basically shape them over time and manage them in a way that is a lot easier on a SaaS platform than it would be on spreadsheets, which typically mean that you've got, as you know, spreadsheets tend to mean more people and error-prone processes and things. So that's one big use case. The second is visualization, where you can have managers that have a special skill into a particular asset class, like fixed income, and you want to be able to show to your clients that you're doing something special. And unless you're able to show this clearly on dashboards that show the right metrics, it's very hard to make your case. Because if all you have is a Bloomberg chart of performance, that may not come across with the real story when you want to talk about credit ratings, yield to maturity, and more granular information. You want to be able to somehow show that you're correlating negatively to certain things and things that matter to your clients. So visualization is very important. And then also allowing people to customize their offering or to combine their product range into portfolios in a way that is very simple. So that's where, yet again, technology can allow such things to happen in real time. Whereas before you would basically need to have a discussion, someone would do some work, come back to you with a PowerPoint. Today that can happen in seconds. And I'd finish with one more thing, which is custom indexing. So the notion of creating something completely bespoke, the kind of thing you and I did back, in the day in the industry, that took a number of people, typing on keyboards. Today you can do this extremely simply with either a notebook kind of interface where people program what they want to do, or a GUI that allows people to click buttons. And as you do that, code gets written automatically, right? So that's the big change versus 10 or 15 years ago. Basically, you enable thought to become an action, and an action becomes code immediately. And then you can launch a product when you're happy that you've analyzed it properly. So that's broadly what we help our clients with. And I guess the one thing that's super exciting to me is that this is only the beginning, because it's all about connecting thought to action, and giving the information to be able to judge better. So it's not necessarily because you want people to make quicker decisions. You want them to make better decisions. But in order to make better decisions, you've got to go through a number of cycles a lot quicker. So the speed comes into the iterative process that takes place as you're exploring things, right? It doesn't mean that all of a sudden you want people to trade daily. No, it means that when you make your investment decision on a monthly or a quarterly basis, you've had so much more data to look at so that you can make a better decision. That's really what it's about. And it's about helping clients across the value chain so that you're able to give this sort of intelligence and transparency much deeper than you were able to before.
Yep. I love custom indexing that Pierre mentioned. So we've spoken a lot about interest rate market and also the global macro piece, So we turn to stock market a little bit because a lot of our, I think, attendees here are very interested in the stock market. And so, I mean, maybe my basic question to both of you, and feel free to add to it a little bit more, is do you feel that the current public stock market is a little bit disconnected from the real economy, given what we've seen in terms of valuation and also the loss of businesses in the corporate sector? Perhaps I can start with Larry first and then move on to Pierre.
So it's a very good question. And I think the honest answer is there's some disconnect, but maybe not as great as many commentators would suggest. We do live in this unusual world where the broad array of fixed income assets, government bonds, corporate bonds, mortgage bonds, and many others simply don't offer very attractive either coupon payments, that is the interest that you would earn on holding those instruments, and even less so, they don't offer the possibility of attractive total returns through further price appreciation, given how low, even negative, interest rates are these days. So the expected returns for most of us, I mean, one can disagree with this, but for most of us look decidedly unattractive across most of the fixed income universe. Doesn't mean it has to be jettisoned, but it does mean that more and more people will be looking elsewhere. And that has, of course, propelled equity markets to some extent. When you though look within the equity markets themselves, what you tend to see though is quite uneven performance. Investors, especially in 2020, but even before 2020, have generally flocked towards business models that are compelling in their ability to either produce above average long-term returns. Large cap growth is in that space, and at times also in business models that just were very sound at delivering current cash flows. Almost everything else, though, performed decidedly less well. And so for those who sort of follow at the broad level, growth massively outperformed value. Large cap massively outperformed small cap. Emerging markets, by and large, fell by the wayside. I mean, again, there are exceptions in sub-periods, but those things have been true. And if you look at the valuations, whether it's price to earnings multiples, price to book, or other valuations, they generally also reflect that. The US market may look expensive, but they're skewing that data with a relatively modest number of companies with very large market capitalization, skewing the data of the overall average, and certainly of the smaller cap universe. And globally, that's also true. You wouldn't necessarily say at first glance that European equity markets or even most emerging markets look to be as expensive as the US has. So there's been a very differentiated performance. And what that means looking ahead is that if we go back to the original conversation about an improving economy on the basis of effective control over the pandemic, then there is the opportunity for what in the parlance we call rotation to begin to add perhaps to successful winners, some of those that have been overlooked or left behind. And those of you who sort of follow the markets on a more regular basis will know that in recent months, that's precisely been the flavor of global equity markets, that we're finally beginning to see selective parts of the emerging complex, particularly those that are more exposed to trade in Asia, doing better than the rest. That we're beginning to see cyclicals in value and financials begin to pick up and small caps beginning to make up some lost ground. That, if it is really going to be the case, if my earlier fundamental assessment proves to be correct, that's probably going to be, has room left to run in it. It can go quite far, it seems to me. We should be closer to the beginning rather than to the end of that process. But as I said, much hinges again on that control of the pandemic and the ability to put people back to work.
Got it. Yeah. Thanks for that, Larry. Yeah.
Hey, Chris, we're about running about 10 minutes over, Chris, so we're going to have to wrap this up to get our next one.
Ask Pierre to also share some concluding remark, and then we will hand it back to you. I see a long list of questions from the audience, but I'll get back to Larry and also Pierre later on separately.
All right, super. I'll make it brief. Thank you very much. I think low rates are having a very fundamental impact on portfolios, and we see this into the way portfolios are being allocated. So simply because people are taking views and shaping portfolio allocation tends to be favorable for equities. The second thing I'd say to this is we're also seeing ESG being a proper force encouraging people to invest further into equities. I'll just share one number with you, which I find is unbelievable, which is if you just look at the top ESG ranked companies, I'm using here MSCI as a bellwether for the measurement of that. Depending on how you allocate, you're basically anywhere between 70 and 90% performance year to date. And you could argue a lot of that is tech. The truth is it's not just tech. So there's something fundamental going on, which is helping further equity allocation. But I'm going to stop here and say thanks. Hopefully we've been able to cover some ground, but
thank you.
Obviously, I would have a lot more to cover if we had the time. Thank you.
Absolutely. We love to see you in Silicon Valley, and we love to see you here as well, Larry. So I know both of you make trips regularly to the West Coast, and please stop by and say hello to us and meet us in person. And hand it back to you, Bill, and also Karim.
Chris, thank you so much. Pierre, thank you. Larry, thank you so much. It's been enlightening.